Hey there, if you're gearing up for the strategic business reporting exam, you know there are some standards you just have to get right. And IFRS 16 leases? It's a big one. It completely changed how we look at company balance sheets. So let's get into it. Because honestly, nailing this isn't just about passing the exam, it's about understanding how to spot what's really happening with a company's finances.
I want you to think about something for a second. Imagine you're an investor, and you're trying to figure out if a company is a good bet. You're looking at their assets, their debts, but what if a huge chunk of their financial commitments, their biggest debts, were completely invisible? Just not there on the main statements. Sounds crazy, right? Well, for decades, that was just how lease accounting worked.
So here's the best way to picture it. In the old world, before IFRS 16, most big leases were treated like your monthly phone bill. Yeah, the expense showed up and it was maybe buried in the notes to the accounts, but it was kept off balance sheet. This meant a company could be on the hook for billions in rent for its stores and equipment, and you wouldn't see that massive liability on its balance sheet. It was a huge blind spot. Now, after IFRS 16, everything's different. Those same leases are treated much more like a mortgage. You've got a massive debt on your books, and you've got an asset to show for it.
Okay, so here's our game plan. We've just touched on the hidden debt problem. Next up, we'll look at the solution IFRS 16 brought in. Then we'll cover some practical exemptions because nobody wants to overcomplicate things. After that, we'll tackle a classic SBR exam favorite, the sale and leaseback. And finally, we'll tie it all back to the ultimate goal of accounting, which is giving a true and fair view.
So how did IFRS 16 actually fix this off-balance sheet mess? Well, the solution is actually pretty clever and revolves around bringing everything on to the balance sheet. It does this by creating two brand new things you need to recognize, a right-of-use asset and a lease liability.
First up, the lease liability. This is the big one. It's essentially the debt that was always there, but was previously invisible. You figure it out by calculating the present value of all the future payments you've promised to make for that lease. Plain and simple, it's your financial obligation, and now it's sitting right there on the balance sheet for the whole world to see. No more hiding. Of course, for every liability, there has to be a corresponding asset, right? That's where the right-of-use asset, or ROU asset, comes in. This represents your right to actually use the building, or the car, or the machine you're leasing. You control its use, so you get an asset. You have to pay for it, so you get a liability. It makes perfect sense.
Now, you might be thinking, wow, do I have to do this for absolutely everything? What about the lease for the office coffee machine? And that's a fair question. The people who wrote the standard thought about that too, and they built in some really sensible, practical get-outs to stop things from getting ridiculous.
And here they are. Companies get a choice here. They can decide not to apply these big, complex rules in two situations. First, for any short-term leases, so anything that's 12 months or less. And second, for leases of low-value assets, things like a few tablets for the sales team or some small office furniture. For those, you can just go back to the old way of doing things and expense the payments as they happen. It just keeps things practical.
Okay, let's switch gears and level up a bit. We're going to dive into a topic that is absolute prime territory for the SBR exam, mostly because it demands some serious professional judgment. I'm talking about the sale and leaseback transaction. So here's the typical scenario. A company is a bit short on cash. They own a big asset, maybe their main office building, so they sell it to a bank to get a quick cash injection. But, of course, they still need to operate from that building, so at the exact same time, they sign a long-term lease to rent it back from the bank. It's a really common way to free up capital.
And here's the critical question you, as the accountant, have to answer. Was that really a sale? Did control of that building truly change hands? Or was this whole thing just a clever way to get a loan, using the building as security? Because how you account for it is completely different depending on the answer. To figure this out, we actually have to borrow some rules from another standard, IFRS 15 on revenue. It all comes down to the transfer of control test. You have to look at the deal and decide, did the buyer, the bank in our example, really gain control? If the answer is yes, then okay, it's a real sale. You take the building off your books and then recognize a new ROU asset for the part you've leased back. But if control didn't really pass, then no sale happened. It's just a loan, and you treat it as such.
So let's just zoom out for a moment and bring this all home. We've talked about ROU assets, liabilities, exemptions, tricky tests, but what's the whole point? All of these rules exist for one single, fundamental reason in financial reporting.
And this is it. The whole purpose is to give a true and fair view of the company's financial position, and specifically its gearing and leverage. For your SBR exam, this is the golden ticket. You need to be able to talk about what this means for investors, for lenders, for anyone who needs to understand how much debt a company is really carrying before they make a decision. And the impact is just massive. I mean, look at this.
When companies suddenly had to pull billions of dollars of lease obligations onto their balance sheets, their reported debt levels shot up. And that, of course, sends the gearing ratio, their debt to equity, soaring. It's one of the most vital signs of financial risk, and IFRS 16 put it under a huge spotlight. So, if you're going to take away one thing from all this, let it be this. IFRS 16 is all about transparency. It's not just some technical box-ticking exercise. It's a fundamental shift to make sure that the financial statements show the true economic reality of a company's promises and commitments. It gives us all a much, much clearer view of a company's health.
And that leaves us with one final thought. Now that these huge liabilities are out of the shadows and sitting right there on the balance sheet for everyone to see, how does that change the game? How does it change the way investors and banks evaluate risk, especially for industries like retail or aviation, where leasing is just a part of life? That's the real-world consequence, and that's why understanding IFRS 16 is so crucial.